I've got a very, very good guest. He only can join us by phone because he's so busy, and it's top secret where his location is until you want to meet with him. But he owns and runs the CPA accounting firm Myers and Myers. His name is David Myers. His son Andrew Myers works with him. And just for full disclosure, David Myers is the Stonehill top level controller as far as finances go within Stonehill. And why that's meaningful or should be meaningful is he understands our business, he understands commissions, he understands everything that we deal with on and on. And he helps us with that top level oversight for all of Stonehill, all the different departments. So he has a really good, well tuned knowledge of Medicare, how it's different from under 65 health and group, and how that differs from life, and all that kind of stuff. And so I thought he would be a great person, not only to kind of explain a couple things from a tax and accounting perspective, but also formally make an introduction should any of you need some additional help with what you're doing, or some advice, or some consulting. He's really, really good. So, as you know, we all kind of live in this little bubble. All of us that are in that bubble kind of know each other, know how it works. But we found that really some really good professionals that have a better in-depth knowledge of what we do actually helps us. And so I think what David is going to help us understand will help clarify some things. So we'll start with the tax and accounting thing first because he has to jump off the call sooner than later. And then we'll kind of backfill with some of those other things that we have talked about and outlined. So, David, I know you're just on the phone. We're going to start with the slide asset types and why it matters, talking about tangible and intangible assets first.
Okay. Pleasure to be here with y'all. Jeff and I have talked about the sales and purchases of an insurance business, book of work. Okay. Just as a few things going, what the real question is, what are you selling? You are selling your client list. If you have an office and you're leasing space, if you're working out of your home office, you probably wouldn't be selling anything. But if you have an office and somebody wants to buy your space, you may be selling some furniture and fixtures. Somebody's coming in, just taking over from where you're at. So essentially, you're selling intangible assets in your of your business. That's just basically your client list and future revenues. Why is that important? Because it has a different tax ramification than if you sell tangible assets. Tangible assets you have depreciation on, and you have to recapture all the depreciation. So in essence, when you sell the intangible assets, you've got a long-term capital gain that you're going to recognize. Now, your intangible asset that you're selling is your client list. Let's say you've been in the business for 30 years, but you've got new clients that came in. Let's say you picked up a book of work, substantial book of work in the last 6 months, and you've got a third of the sales prices associated with that new book of work. That's still going to be long-term capital gain because it looks to basically the time you're in business. So you're selling your client list, you're selling your future revenue streams, essentially. Now, it matters because the character of the game, and depending upon what your other income is, in the year that you sell, let's say you sell December 31st or January 1st, and if your income is going to be substantially lower, taxable capital gains can be taxed as low as 0% interest, 0% tax. If your other income puts you in the 10 or 15% tax bracket, your capital gains will be taxed at the 0% rate. From there, you go up to a 10% rate and then 20% rate. So it's always going to be less than your regular income tax rate. If we go to the next slide, you look at what you're going to be selling. It's just your entire book of work. Now, do you have to sell your entire book? The answer to that is no. If you sell one client, you still get capital gains on that, the sale of that book, that part of your book. If you have two locations that you sell out of, and I know many of you probably do have several locations that you may sell out of. I know a person that is in the real estate business, but they sell real estate in California and in Utah, and they're licensed in both states. If they sold their book, if they were in the insurance business and they sold in one location, they could get capital gains on the sale of that part of their entire book of work. Whatever price whatever part of their customer list they're selling. So it's all of these different types of policies or premiums that you may be receiving from the sale of whatever policy it is. And the difference between these things is going to be a valuation issue. And Jeff will talk about that because different products have a different valuation factor to it. Now, when it comes on the next slide, if it's asset and entity purchases, understanding that some providers do not like to issue a 1099 to a business, to a corporation. Therefore, they put it in, send a 1099 to your individual name. If you have an entity that you're working out of, an LLC or S Corp or partnership, if you're with someone, if you have this entity that you're working out of, and a lot of times I like to, depending upon the amount of income you're making, revenue you're generating, if you have an entity, there is a possibility, there is a benefit to having that entity and being an S Corp. The entity can pay you a wage, and that wage is subject to self-employment tax or Social Security and Medicare tax. If you make, for example, if you make $100,000 net in a year, and you pay yourself a wage of $60,000 during the year, you're going to pay 15.3% of that 60 in Social Security and Medicare tax. Okay, so that's about $9,000. The other $40,000 that comes through to you will come through to you as dividend income on a Form K-1 for, if you're in an S Corp. That income is not subject to the self-employment tax. So you'd be saving 15.3% of the $40,000 in self-employment tax. So you'd be saving about $6,000 in taxes. So there's a big benefit to having an entity out there. Now, when you go to sell your book of work, it's the holder of that book of work that is the seller. So if you're practicing in an entity, if you have a business entity that's you're using, that's the seller. Now, I understand that a lot of you are going to be receiving 1099s in your personal name. Generally, what we do with those, we put them on your personal tax return, but then we back it out and say, commissions paid to, John Insurance Agency. So the Schedule C on your personal return goes to zero, and all those commissions are reported in the entity's tax return. So even though the 1099 you receive from the provider may come to your personal name. We treat that as an asset of the entity. Now, why are we talking about asset sale versus entity? Nobody's going to want to buy your entity because there's too many, potential liabilities that you may have in the entity, and they're just going to want to buy the assets of the entity. Also, if they buy the entity, if you're an LLC or S corp, they're buying an asset that they cannot amortize. So what they buy is just this asset that's going to sit on their books and never get written off. So they want to buy your goodwill, your customer list, and they get to write that off over a period of 15 years. They get a tax deduction for the purchase price, essentially. Now, it takes 15 years to realize that tax deduction, but it is better than nothing. And so most business acquisitions that you see nowadays, especially with small businesses, are asset purchases. Now, again, you don't have to sell your entire book in order to, sell something. I've worked with agents when they've sold a segment of their business. They may sell one particular line, like long-term care, or a health segment, and just getting out of the providing of those policies. So you can sell whatever you want, but be aware that they're not going to be buying your entity. Now, why does this matter? Because depending upon how you structure the buy or the sell, you're going to receive, if and Jeff will cover this, you may receive a flat cash purchase price. If that's the case, then you're done and it's over. The transaction's over. But if you receive some sort of a term payout, in other words, if you're going to receive the payments over 3 years, you're going to recognize that income over the 3 years, 3 or 5 years, however long you negotiate the deal for. Now, who's going to recognize that income? The income has to be recognized in the entity, so you have to keep the entity around for the entire duration of your contract with the buyer. So when the payments are received, those payments need to be received by the entity that sold the product. Why does this matter? Because if you transfer that contract from the entity to yourself and you just do away with the entity and say, oh, it's just be easier if I recognize the income, technically you have to recognize the income when you distribute that note receivable from the entity to yourself. I know it's weird because you're effectively taking the entity's note receivable out of your right pocket, putting it into your left hand, and putting it into your personal pocket, which is your left pocket. So there's no allowance that it's the same person owning it. It's just part of the law that if you take that out, you've got to treat it as a dividend to you, and the dividend is measured at fair market value, which would probably be the face value of the note. So you would have to recognize the full income in the year that you transfer the note out. So you can't do that. I mean, you can, but you don't want to. You just keep the entity around and file a tax return, file a capital gain on the tax return. And in those years, I suggest you don't pay yourself anything because you're not providing services. So you get the capital gain in, you recognize capital gain, and that's it. And you keep the entity around filing tax returns for as long as you're receiving payments. That was probably a law written by accountants to keep us more gainfully employed. I'm sorry.
But that was a funny.
That's what. Pardon?
That was a funny joke.
That was a funny joke, but what can I say? It's really quite unnerving when you realize, as I do every day almost, that the only reason I exist in my business is because of government edicts. You know, why do people use me? Because they're forced by the government to file taxes. And thus they're forced to use me, some of them. Anyway, the next slide, methodology of payments, and Jeff is going to go over this a lot more because he's going to talk about the terms of your buy-sell agreement. The lump sum would be you get the payment, all of it's taxable to you in the year of receipt, and again, all of it's ordinary income. Over time and as earned, to me, are effectively the same, okay? Because over time, you're going to be receiving it over 3 to 5 years. As earned is another method of valuing how much you receive, okay? What dollars you're going to get. As earned, as Jeff will go over, it gives you a higher valuation. But it's basically because you have no basis in this asset, other words, there's no cost to you, unless you did buy a book of work from somebody else. But basically, all your payments you receive on the buyout are going to be taxable to you as capital gain income, okay, which is very beneficial. Now, on the next slide, we have why taxable events matter. You know, why does this matter? And I think I've already talked about some of this. It's the benefit of the capital gain versus ordinary income. And if you do happen to sell any hard assets, furniture, fixtures, anything that you may have, you probably have recapture of depreciation, and that's all income to you. Okay, and that'd be all ordinary income on your tax return. Okay, now what are you going to receive when you sell? You're going to probably receive some 1099s on documents you're going to need for the tax prep, and you're going to want to provide your tax preparer with a copy of the buy-sell agreement. I would suggest that you get your tax professional involved in the structure of the deal from as early as as early as you can once a deal is starting to be negotiated. Why? Because some people may want to, some buyers may want to allocate a larger portion to a non-compete clause. A non-compete clause, basically they're going to say, okay, we're going to pay you half the purchase price to say you're not going to compete with us for the next 2 or 3 years. That's, in the tax world, that's ordinary income. That's not capital gain. That's basically giving you remuneration for sitting at home and not doing work, but it's ordinary income. You don't get the capital gain treatment off of it. And it's just ordinary income as anything else. So you want to get your tax professional involved in the negotiation or in the terms of it so that they can advise you and try to get as much into capital gain income as you can. You're going to be receiving a 1099 probably from the buyer that details out the total payment to you. Now,
can I ask a quick question?
Sure.
So if you were to take payments over time, so let's say I sell my entity for $240,000 and I take $80,000 a year for 3 years, would that all fall under the zero taxable capital gain because I'm taking 80,000 or less than the threshold per year?
It all depends upon your tax return and your individual circumstances. If that's the only income you have, okay, if that was the only income on your personal tax return, yeah, and you're married filing joint, yeah, you'd be a 0 tax rate. But if you have other income in there, you
Like
may
Social
get
Security.
above. Pardon?
Like Social Security, that would mess it up.
Social Security could mess it up because Social Security may or may not be taxable to you depending upon income again.
Right.
Okay.
Threshold
But-
isn't based on the purchase price, it's based on your annual total income.
Correct. It's based upon your taxable income. Okay. And really, it's based upon what tax bracket you are in. Like I said, if you're in the 10 or 15% tax bracket, your capital gain tax rate is 0.
Yeah.
Now, if your capital gains put you above that in the tax bracket into a higher tax bracket, then you'll be paying a 10% tax rate on that portion of the capital gains. It's not the entire thing. It's graduated basically. So you may have an average rate of 5%. Okay. So
Okay.
you're going to get the 1099, and I haven't talked to Jeff. I don't think the purchase price is properly reported on a Form 1099 because 1099 NEC, non-employer compensation, is for compensation to a independent contractor. Okay, so you may get it on a 1099 MISC, miscellaneous form. I don't think that's the right place. I don't think they should be reporting it to you personally, but you may get it. And if you do get the 1099, you need to put it on your return and then back it out. Now, you asked if I sell my business, you've got to keep, you're going to basically sell the book of work, not your entity. And you need to keep the entity alive until that last payment is received. Okay. You also have other taxes that may be due. In other words, state tax. And you're looking at just a straight 5% state tax in Utah. Now, if you sell out of state and file in multiple states, the capital gain will only be taxed in your state of residence. It does not flow through to where the customers are located. The capital gain is taxed only in your resident state.
Oh, okay. Yeah.
Okay. So, the important things to note are, one, get your tax professional involved so that they can make sure that the structure of the deal maximizes your capital gains. 2, a non-compete clause is ordinary income. Okay. So if somebody wants to allocate a big portion of your purchase price to non-compete, well, you don't want that. They're trying to get the benefit to the buyer in that situation is if they give you a third of the purchase price in non-compete clause over 3 years, they get to write that off in the year of payment rather than amortize it over 15 years. So you want capital gain. You want to avoid as much as you can non-compete clause. You can have a non-compete clause, but don't have a non-compete payment. And then you've got to keep the entity, if you're dealing in an entity, you got to keep that entity alive until the payments have ceased, until you receive your last payment. And I believe that's about it. Are there any questions?
So here's
Jeff, that was it.
here's David's contact information. You can always email me and I'll get you in touch with him. But like I said, he's a wealth of knowledge. The thing I really, really like and admire about David is he's more of a consultant. So almost all of the big contracts that Stonehill signs with, that have tax ramifications, we actually follow his advice and we get him involved in the early stages of those contracts just to make sure from a tax standpoint that that we are the beneficiaries of how those deals are structured. And so, if you use somebody like David or your own CPA or whoever that may be, just make sure you involve them in the process of, the purchase agreement and things like that, just so, and get them involved earlier than later, because that always pays big dividends. It certainly has from our experience.
Yeah, and there's sometimes where you think tax law is not logical. It's tax law. It's rules made up by Congress. Now, if you look at Congress, you can know how screwed up the tax law is going to be. So you may think, here's the way it should be. It just seems logical that it's this. It ain't going to be that way. There's always going to be curveballs that they're throwing at you.
All right.
Therefore, get your tax professional involved.
Thanks, David. I know you need to run. If there's any other questions, I'll kind of work with you on those, and we'll get answers to people should they have additional tax or accounting questions.
And feel free to email me. Okay?
Yep. He's very good.
Okay.
Thanks,
Thanks,
David.
guys. Thanks, Jeff. Bye-bye.
Okay. So let's talk about a couple things that actually pertain to, we'll get back to valuation and how that is and why that is. And very simply, in general, the value from policies that are in your book of business are policies that are underwritten, guaranteed renewable, and that have vested future commissions. So examples of those are Medicare, supplements, advantages, all the ancillary products, long and short-term cares, life products, whole lives, final expenses. Now, term and annuities do have value, but only if there's a renewal stream. So if you take your term and your annuity up front, or like in a 2 lump sum and you're in year 3, those policies, of course, aren't going to add to the valuation. Individual health on and off exchange actually add to that, and small and large employer health groups all kind of make up generally what can be considered products that add to or are considered for evaluation. So I get this question a lot. How can I increase the value of my book? And a couple things is just to sell new business, have multiple products per client. Many of you already do this. You'll sell an MA, you'll throw in a GTL, maybe a life policy, maybe a short-term care, et cetera, et cetera. And those all increase the value of your book. The other thing is to concentrate on the product type and the commission schedule. And what that really means is there are products that actually pay more and have longer or sustainable commission schedules. Let me give you an example. A lot of us sell United Healthcare Medicare Advantage plans, and you look at your commission schedules and you think, why in the world did, when I sold a Medicare Advantage plan back in 2017, am I only getting $15.12, but gosh, 3 years later, I'm getting 17, and then this last year I got 22. You contrast that with other carriers that actually say, hey, whatever your block is, we're going to take you up to the latest level. And those are just things to remember and things to consider. Not that you shouldn't sell one type of policy or a certain carrier's policy, but those things add value. The carriers that continually increase the commission across the board actually create more value than those that actually don't. So that's something just to think about as you're deciding which policies, which carriers to sell when you have a choice. Sometimes you don't. Keep it as fresh as possible, which means, just make sure you're always looking and looking over your block of business. Are there other products that you need to consider? Are there things that you need to fill in, gaps that need to be filled, et cetera, et cetera? And then make sure you're rewriting business that's not generating a commission stream. which is just good management. So if you have policies that have fallen off that commission schedule, they're still on the books, but they're no longer paying you anymore. Maybe it's time to actually look at that and see if there's other policies, other products that have now been updated that not only would be good for the client, but also could continue generating a commission stream. Increased value is digital. Does that mean if you don't have a CRM, your value is a lot worse? No. But is there an increase to the value of your block if it is in a CRM and organized? Absolutely. So think of doing that. It's good for you, and it's good for whoever's going to purchase that block. Here's one that a lot of you may, assume. We certainly do. But when you sell to your upline, whether you're in an agency, a GA, an MGA relationship, somebody like a Stonehill, those additional override dollars are valuable. And so we, Stonehill, will pay more than Joe Schmo on the street, because we know if that block of business moves outside of Stonehill, then we lose the potential overrides when that block goes to another entity. So we recognize that, and we put that into the valuation that we do on blocks. And again, I kind of talked about certain carriers and policies in certain states. As you all know, certain states have different levels of commission schedules, and certain states pay more. And so just keep those as little points of reference as what could increase the value of my block. Now, conversely, what decreases the value? Certain policies have tiers. The longer you are in those tiers, the less value that it creates. So for example, let's say you have a policy that has a 7-year tier commission structure to it, and you're in year 5 of that tier. Well, you're not going to get credit from the valuation of having those commissions continue in perpetuity. That's only going to be recognized for those next 2 years. And so that's something that definitely decreases the value. Older clientele, because people fall off the books when they pass away. If there's little or no growth in the book, so you're just kind of sitting on it and doing that kind of stuff, that's actually decreases the value. Because the increase that we just talked about of adding new is something that always kind of refreshes and updates, and just an old growth book of business is not going to give you the same value as something that is continually being worked. If there's a history of low persistency, that actually decreases the value, of course, and ultimately delaying the execution of your succession plans actually decreases the value in the long run. Why? Because commissions have a life cycle, a life expectancy, and as they run out, the value decreases. And of course, certain carriers, if your book is mainly in an older book written by certain carriers and you have less commissions being generated from older policies, that's going to decrease the value. And again, certain states actually can decrease the value because of state payments there. So is there a best time of the year to do evaluation? There absolutely is. It's January through August. Why? Because after August, we're all involved in AEP, OE, whatever you want to carry it or call it, depending on what you're selling. Some carriers have blackout periods that you cannot transfer your book outside or during open enrollment or OE. So you might want to be in a position to do a succession plan, do a purchase agreement. And some carriers just say, well, that's great, we'll recognize that, but we're not going to do anything about that until after AEP or OE is over. And all that does is delay the payments ultimately from the seller to the buyer, or the buyer to the seller. And then, of course, as we're kind of getting ready for this new season, certifications, recertifications, testing, and everything, after August, we kind of go into that mode. And many times that kind of takes all of our time, effort away from doing something that can be worked on earlier in the year. Okay, so what do you need to determine the value of your book? It's really, really simple. As David stated, really it's the clientele, it's the commission stream that is being purchased. That is the asset. And so to basically figure out the value, all you need is the last 12 months of commission statements. And the reason why is the multiple is based on the annualization of your last 12 months as a starting point. Make sure to include every single carrier you receive a commission from. We just did another purchase with somebody, and at first the commission numbers were a certain number until we realized that, oh, there's a little bit more that was coming through, and then we actually had to add that in. So make sure that, and this goes back to the organization we talked about last month, is to make sure that all that is well organized. Paper statements or digital copies work to kind of come up with what that value is. That, again, going back to the commission statements, if they're paper, fine. If they're digital copies, that's fine. The other thing that I actually prefer to do, and I think it gives you the most accurate and the highest value, is just providing your agent portal login information, because of course you can just pull accurate statements, accurate books, accurate counts, all that information. So those are the things that you really need. And then once we have those, we actually do a detailed commission analysis. Anybody who purchases your block is really going to do that. And that's actually going to be an analysis down to the individual policy level, which again goes back to how old the policy is, what the effective date is, what the type is, what the commission schedule is, does it end, when does it end, who are the carriers, the states that the clients are in, and then we do a little forecasting as persistency, death rates, and lapse ratios go, to see what types of impact that may have in the block. So after you have your annualized gross commission, you actually, standard in our industry is to apply a multiple. And the multiple is what's multiplied to the annual gross commission. So as an example, let's say we have $100,000 in annual gross commissions. 1 to 2.5 are the usual and customary multiple ranges for books of business that we're talking about. Now, does that mean you can't do less and you can't do more? No, that's just the usual and customary multiple ranges. So in this case, if we take the $100,000 of annual gross commission and we put a multiple of 1 to it, or times it by 1, we get 100,000. Up to 100,000 times 2.5 would give us 250,000. And that's as simple as it gets. So there's a couple of payment structures. David talked a little bit about this and why that might have some tax, how that is treated differently from a tax standpoint, how you have to recognize that income. But really simply, these are 3 common types. Remember that customization is something to really consider. It's your book of business. You need to do it your own way. From our experience at Stonehill, we've done these examples. We've done custom and pretty much everything in between. So there's no right or wrong way to do it. It's just this is a place to get started. But to run through this real quick, they're typically a lump sum over time or as earned. The lump sum is going to give you the lowest valuation because it's riskiest for the buyer. You get all your money up front and then you're done. You can just wipe your hands of it. Over time, you get a higher valuation somewhere in the middle. The money's guaranteed typically for that time frame, and it's risky, but it's not as risky for the buyer, hence the enhanced valuation. And then as earned usually is the highest valuation. The money's not guaranteed because if your book continues to decline in a rapid rate, you're only paid as the commissions that come through on that block. And of course, that's not as risky for the buyer, but you receive a higher valuation because you're both taking a risk. Now, I've actually seen, and we actually have a couple examples of this that we've actually participated in on an as earned, where the block actually increases. And it depends on who's going to purchase the block. But at Stonehill, we recognize everything that comes from that block as being added to the block. What that means is, let's say we purchase a block from Nancy Harris, and she has 100 clients. And over the 5 years that we do that, it actually turns in from 100 clients to 120 clients from referrals and all the things that we do to actually help increase that block. Well, Nancy benefits by those additional clients, that additional revenue, and that's actually paid to her as part of that higher valuation. But, on the contrary side of that, if we purchase a block from Nancy with 100 clients and it's an old block and 80% of everybody passes away or falls off the books or whatever, she's only going to be paid for the remaining 20%. So as you can see, there's different ways to do it there. And the reason I give you 3 kind of common examples is you may want to, and David mentioned this, you may want to just sell a portion here, a portion there, and maybe one's a lump sum and one's over time. And, at the very end, it's maybe as earned. And so there's many options, but that's kind of the example of options that are typically given payment structure. All right, expectation and timelines. Typically what happens is there is an interest in initial discussion. We gather commission statements, analyze those statements. That can take as little as 3 days, or I'm currently working with an agency, and we're at a year and we still haven't completed all the gathering of commission statements. So we can't analyze them yet. And so it depends on when all that kind of stuff comes together. After the analyzation, there's the value multiple payment structure discussions. This is where you would probably want to get a good tax professional involved as you kind of go through those things and structure those payments and what those multiples might be. David kind of made mention that there's intangible and tangible assets, and depending on what you have and how you're set up, those things need to be discussed as well, whether those are going to live and breathe in the agreement, the purchase agreement, or if that's going to be set outside of the agreement. The purchase agreement is generated, reviewed, signed, and then the carrier transfers start, whether it's an AOR, a successor agreement, block or book of business transfer, et cetera, et cetera. Every carrier kind of calls it something different. And that typically takes, 2 to 3 weeks to 2 to 3 months, depending on the carrier. And like I told you last month, there are some carriers that are very, very slow, and we still haven't completed a couple transfers with a carrier. And if we're getting close to, it'll be a year in February. So those just kind of take place. But for the majority of the carriers that we all deal with and write, they're very good at doing these types of things. And from a timeline perspective, you can get this done in very short order. We just did one about a month ago, and from the interest and initial discussion to gathering the statements, doing the analyzation, the valuation, and having the purchase agreement done, we did that in about 10 days. But that really, that really was because the statements that needed to be gathered and the review of the discussions and the involvement with their CPA to make sure that was done in a very streamlined and orderly manner. And so in 10 days, we had it all done. That was about a month ago, first part of June. So we're about a month in. 2 of the carriers have already agreed and approved that. And the last carrier should be approving that in short order. So with this instance, we've gone from start to finish. It'll be 2 to 3 weeks before all that transfers over. So within a month and a half, 2 months, signed, sealed, and delivered. Like I said, others take longer, and there's no pro or con to doing that. I just give you those examples because if you want to get it done quick, you can get it done quick. So again, agentretire.com is a resource. As soon as this video is done, I'll actually add it to the page. This is what it currently looks like. You can see that I've added part 2 from our last discussion. So early next week, there'll be part 3 that you can review if you want. And I'll make sure that any of the additional things that we've talked about, documents and things like that, are included. So there's a little bit of a library there. So in summary, first of all, many thanks to all of you for participating for the last 3 months, whether it's been in the live one or whether you've reviewed these later. I know we've done these through the school summer season, and many of you have been traveling and couldn't be on the live version, but many have followed up with me and said that they've appreciated what we've done so far. But remember, in number 1, it was just hopefully a plea to get started, to begin the process now, even if you're not ready, but just to start having those conversations, especially about the expected and unexpected scenarios. In our last one, we talked a lot about checklists and organization, sample agreements, things to consider. Again, there's no only way to do it, but these all should help you kind of get your proverbial ducks in a row and get your organization around how you may want to do it, and putting a finer point on that pencil. And then we kind of launched the Agent Retire page as a resource, so take advantage of that. And then today, we really looked at how to come up with that value by taking your 12 months of commissions, putting a multiple on it. That gives you a starting point of what your business may be valued at. There's other things to consider, and when you get to that point, we can expand on that a little bit. But that gives you a good place to start. Consider the choices of different ways, possible places, ways to be paid, and the tax ramifications that come from that. And then a timeline. Again, you can do it sooner or later. There's no, again, perfect way to do it, but there is a process that we have to follow to make sure that follows suit. And then again, I hope David Myers shed a little bit of light on things to consider from a tax standpoint, the benefits of doing an asset type of a purchase, why entities need to be around for a little while, but make sure you take advantage of a good CPA or accounting firm. If you don't have a good CPA or accounting firm, I'm biased, but David Myers is really good. And the reason why is he just understands our business. He understands insurance in the ways we understand it. And then, of course, last but not least, let us help you if you have any questions. And like I said before, if you want to do something with Stonehill, great. If it's just that you have something already done and you just want our opinion or things that we've learned, that's great too. At the end of the day, we want you to feel like you gain great value from Stonehill, whether we benefit or not. Because at the end of the day, we really want your clients taken care of. We appreciate the business that you write with us, and we want to make sure that is always valuable. And so that's kind of where we've been and where we are. And I hope that this has been meaningful. I know we're getting up right to the hour. I want to be respectful of everybody's time, but take advantage of the things on agentretire.com. Of course, email me anytime, call our main number at the office. If there's anything that I can do or Doug can do or Nancy to do to actually help you with these things, we're more than happy to do it. So